Hello everybody. Today's video we're going to talk about the UK stock market. Whether you're based here in the UK or you're in the US or anywhere around the world, the UK market has had a lot of headlines over the last couple of years and they've not been good. So today we're going to dive into it to see why and what you need to know before you would consider investing into this unloved stock market right now. Hi, I'm Jeff. I've been working in the financial markets for around 20 years now, and I want to start sharing some of the knowledge I've gained over that time with people like you. It's all so confusing sometimes. There's so much going on, so much different jargon. So I want to kind of simplify things and help you get up to speed on how the markets work and understand the different asset classes and really what's happening and different things that you can look at. I'm also a very keen and passionate saver and investor. So if you want to pick up some tips and tricks on how you can save more money, get it invested and reach your goals, and subscribe to my channel because there'll be a lot more videos coming. By the way, I need to note, this is not financial advice, okay? I'm really just handing off some of the information that I've learned over the years. It's really just for education and entertainment purposes only and nothing else. If you need financial advice, then seek out a qualified financial advisor. All right, so the UK stock market, let's get into it. The main index that you see quoted a lot is the FTSE 100. FTSE just stands for Financial Times Stock Exchange, and the 100 are the largest companies that trade on the London Stock Exchange. So these are big companies, they tend to generate a lot of profits, and they tend to be huge international companies. Think the likes of BP and Shell, Unilever, companies like that. One really important thing to note, these companies are operating in many different markets and they tend to have a lot of their earnings outside of the UK. In fact, 70 to 80% of their earnings come from outside of the UK. So when you're trying to get a gauge of the UK economy and what's happening domestically, the FTSE 100 isn't really a good gauge of that because they're earning money in all these other places. And they tend to do so in dollars as well, so that's another thing worth knowing. And when they convert those dollars back into pounds and release their earnings, then, well, there's some currency exposure there. The pound and the dollar are going to move in different directions, certainly as we've seen since 2016 with the pound having sold off so much. So there's a lot of different moving parts to the FTSE 100, but one of the main takeaways that you want to know is overseas earnings. Around 70 to 80% of those earnings come from overseas. So it's not a particularly good gauge of what's happening with the FTSE, with the actual UK economy itself. The FTSE 100 is made up primarily of banks, mining companies, consumer staples, energy, things like that. What there isn't a lot of is technology. So what you will get is a bit of a higher dividend because tech companies don't tend to pay as much of a dividend, and those industries I just mentioned do. So the dividend yield on the FTSE 100 tends to be between 3 and 4%. Because the FTSE 100 is made up primarily of industries that are not technology and the things I mentioned like banks, industrials, consumer staples, the returns have been pretty poor. In fact, going back to April 2000, it's only returned each year compound on average 4.79%. That includes a dividend yield of between 3 and 4%. So the returns on the FTSE 100 have been pretty poor. So another index to look at when you're looking at the UK stock market is the FTSE 250. This is really the next 250 companies down after the FTSE 100. In other words, they're more your mid cap and your small cap. These companies do their business in the UK and they tend to generate most of their earnings here in the UK. So it's a much better gauge of what's happening in the UK economy. They grow a little bit faster, they pay a little bit less in dividends, but they still have a pretty good dividend yield. The FTSE 250 yields around 3, little over 3%. The annual returns on the FTSE 250 has definitely been better than the 100 as well. It's in and around 8.48%. Both the FTSE 100 and the FTSE 250 have had some pretty bad headlines over the last few years. IPOs like Deliveroo that really didn't go well. Headlines of retail investors pulling out around £25 billion out of UK stocks in the last 2 years alone. Reports of British pension funds only holding 4% of their portfolio in UK stocks. It's been really, really bad. And because of that, the valuations have come down so much. If you look at the valuation of the FTSE overall, it's really around 14 times. That's the price earnings multiple, which really just tells you how expensive a market is. Let me give you an example. If a company earns $1 per share and their stock price is $10 per share, well, that's a multiple of 10 to 1. And the higher the number, the more expensive. So the S&P 500, for example, which has a lot of tech companies and other high growth companies as well, the multiple or the how expensive the S&P 500 is, it's trading at around 26 times earnings. If you compare that to the UK, like I say, around 14, there's a big difference in valuation there. The UK market is extremely, extremely cheap. So given the fact that the UK market is so cheap and just so unloved over the last few years, why would you even consider even looking at the market? Well, when valuations are low, some long-term investors who particularly like to focus on value, how cheap a company or a market or an index is, those are value investors. Well, this is exactly what they look for. Their idea is to buy when it's cheap and give it time to grow and recover. So what could be the catalyst or things that might happen or reasons why you should even consider adding a little bit of the UK market to your portfolio? Well, there's a couple of things to consider that might be some positive news and might help the UK economy over the next couple of years. Number one, we've gone into recovery mode. That's right. So the last 2 quarters of 2023, so the second half, there were 2 quarters of negative GDP and 2 consecutive quarters of a negative GDP. GDP, gross domestic product, just the growth figures. But if you get 2 quarters in a row of negative figures, that's actually a recession. So the UK technically entered a recession at the end of 2023. But the first quarter growth was positive, and that is a sign, early sign, but it is a sign of a recovery. Okay, so a recovery in GDP and growth figures. Another thing we've seen lately is an awful lot of foreign buyers, foreign investors coming in and putting bids on UK companies. They're only doing this because they see value and they think the market may have bottomed and they are going to get a return on their investment. So we've seen a lot of this over the last year or so, and it's a really good indicator of some positive views from outside investors on the UK economy. Another reason to be positive, the last inflation print was really good. Inflation, which had been up around 10% back in 2022, has come down to 2.3. This is well within the normal range and very close to the Bank of England's target rate of 2%. And because inflation has come down to 2.3%, there's a lot of talk right now of the Bank of England being able to cut interest rates sooner, maybe, than was expected. So we may see interest rate cuts happen sometime in the second half of the year this year. Another reason that some people might see cause for optimism is there's going to be an election. And with an election, it appears, if the polls are to believe, that we may have a change in government. Now, I'm not advocating one government or one party over another. That's not what this channel is about. But sometimes when you get a political change like this, and it looked like it could be a big one, the psyche or the impact on the people can be very positive, and you may see this as a fresh start, a reset, and potentially some more good things to come. So if you think that some of the things I just mentioned are reason for optimism on the UK economy, if you're a value investor and you just see such good value in the UK, low PEs, the pound is so low as well. If you're buying with US dollars or euros, for example, as the foreign investors are on their takeover bids here in the UK, you may be picking up a really good deal. So how would you go about doing this as an individual or a retail investor? Well, you could pick your own stocks, pick individual stocks if that's what you want to do. If you like to pick your own stocks, then you can look at companies in the FTSE 100 or the FTSE 250, depending on whether you want your exposure more domestic or you're happy to have a more international exposure of a UK-based company. But yeah, you can do that and buy stocks on the London Stock Exchange. Most brokers will offer that. If you don't want to get into picking your own stocks and you just don't have the time to allocate to going through financial statements and everything, then you could look at ETFs, an exchange traded fund, which will just pick up a basket of stocks and diversify over many companies. So for example, I mentioned the FTSE 100 earlier. If you were interested to get exposure to that, one example you could look at is the iShares ISF, which trades on London, and that will give you an exposure to the 100 largest companies on the London Stock Exchange, i.e. the FTSE 100. If you want to get exposure to the FTSE 250, and like I said earlier, that's an exposure more to the domestic UK economy through more small and mid-cap companies, and they haven't had quite the returns as the FTSE 100 has year to date, so there might be even some extra value in there. But there's a couple of good ETFs as well, and one that I look at a lot is the Vanguard mid-cap ETF, ticker VMID. That trades on London, and you can have a look at that one. So if you want exposure to the FTSE All Share, which is really the 100 and 250, then yeah, you could look at an ETF, FTAL, which trades on London, the FTSE All Share ETF, and that will give you exposure to everything. If you're an investor in the US and you want to buy something domestically for you, then you could look at iShares ETFs EWU and EWUS. S includes the small caps as well. So look at those tickers. This is not an investment advice, as I said earlier. So have a look at the fact sheets, the key information documents, and all the information on those ETFs. But that's a good place to start if you think you want to add a little bit of exposure to the UK market in your portfolio. If you're in the US or Canada, Europe, or another place, sometimes it's really good to look overseas as well and just diversify a little bit. So that's my video on the UK stock market. We touched on the FTSE 100, the FTSE 250, a little bit of on the ETFs that you can look at to get exposure to those two indices. If you like the video and you want to hear more around investing, saving, then subscribe to my channel. You'll get some more good videos like this. And if you like the video, give us a like, and I'll see you in the next one.